that don't help you. So I just hope you guys understand it's all coming from a good place. And this isn't something that we normally do. And we just feel that in this market, in this environment, excuse me, I feel it's irresponsible if us as a team, if we're not getting in front of the information and trying to disseminate it in a way that we can get it out to our people to try to help you understand some of this, because there is no question that in environments like this, we see that game of telephone that goes on, right? Where, like Liz alluded to, the rumors, and you hear one thing, then another lender tells you something else. And especially being a real estate agent, I can only imagine how confusing that is because you've got multiple people telling you kind of different versions of the same thing. And you're not quite sure what to believe and what's really going on out there. So I'm hoping I can give you guys some version of clarity today on some of these items. And you know, to be frank, we're all learning this as we go, right? So, I mean, I'm no expert in a COVID pandemic situation, so I'm doing my best to take this information and understand it for myself and hopefully be able to speak relatively intelligently about it. But I just say that because I don't want you guys feeling like, you know, this is something that we're used to doing, and everybody's in uncharted territory. I think we can all agree on that at this point. And so whether it's the people making the decisions at the very top, to everybody in the bottom and in between, no one really knows what tomorrow's gonna have for us with this whole situation. So anyway, that being said, I think if we want to just start with kind of the State of the Union, you know, we listed just a couple bullet points on here as far as forbearance, rates, refis, and adaptability, and we'll just quickly explain what we mean by this slide. The first thing to understand is, as we moved into this COVID situation, rates started to come down very quickly, okay? And this was in the beginning of March. So in the very beginning of March, you saw almost this perfect storm when it comes to the lending world, where interest rates took a very steep dive very quickly. And they almost shot up just as fast, and I'll come back to that in a second. And at the same time as that was happening, this whole COVID thing was unraveling. And when I call it the perfect storm, it's because it's one thing to inundate lenders and the financial markets with high loan volumes. And then we have to manage to that. We have to make decisions based on how do we prioritize what files, what do we need to do? Do we need to hire more staff, right? The ebb and flow of the mortgage industry has always been a challenge because, as you guys probably feel in real estate as well, there never seems to be this happy flow. And I've been doing this a long time. It's always either seems to be like it's not busy enough or we're so busy, and they happen and it changes overnight. And so as organizations and mortgage entities, that's one of the hardest things to manage as far as, you know, staffing to that, because nobody wants to have a culture where you staff up when it gets really busy and then you have to let people go. So you have to be very careful, and you also don't want to burn out the people that you do have there, and you got to respect their life balance and, you know, those kind of things. So, so in this perfect storm, not only did we get hit with inundated historical volumes that caused all those things I just said for us to kind of come to the table to make decisions on, but at the same time, the world was starting to get flipped upside on its head and get shut down. So you had all sorts of other problems happening, which are just, if in my loan journey from A to Z, you know, that process to manufacture a loan, there are more buttons we push and levers we pull to kind of get it through that assembly line. And if we have challenges pushing those buttons and pulling those levers based on third parties we deal with, whether it's an insurance company, a title company, a creditor, because, you know, we have to prove someone's paid off a a credit card, and we got to get proof from that creditor on it. All of those people begin slowing down and having delays and issues as this COVID thing unraveled. So you have that perfect storm of dealing with high volume on top of the process now not functioning the way that we're used to it functioning. And we're going to talk more about that later so you guys can understand what's really transpired there and what to kind of look out for on your end. On the rate topic, you know, as I said, they shot down. It was like March 4th and 5th. Okay, rates got really low, really fast. 30-year fixed basically was just right above 3% for all intents and purposes. Okay, these are generalizations. You guys understand that rates are sensitive to the transaction, the client. But but rates got that low. And then they almost immediately overnight, as far as, the way I gauge it, shot back up to almost near 4%. So that's a massive swing upwards. That's not normal by any stroke. And the reason that happened, one of the reasons is banks got flooded with so much volume that they couldn't handle it. So they literally started shutting down their pricing desks, their secondary departments, which handle all the lock requests. And they just temporarily put their price sheets on pending, which means that mortgage companies can't lock rates with them or send commitments in. And it's very rare I've seen that happen in all my years of doing this. And when that does happen, it tells you that that's a whole lot of hay just came off that truck and got dumped in front of the factory. So when that happens, lenders, and this may sound strange, lenders will mitigate and control their capacity and their volumes by turning the knob up on their pricing. So even if in the markets, based on the fundamentals happening, such as what's happening in the economy, we would all say, hey, rates should be super low right now. And then we went and called our lender, and our lender said, well, you're actually at like 3.875 right now. And you're going, I don't understand. I thought rates were at 3. And those are real conversations every lender across the country was having. And the reason for that is because banks turned their rate sheets up to ward off more volume. Because if you think rates are at 3.1 and you call and your lender tells you 3.8, very few people are going to lock on that deal. And it's just psychology. They're gonna wait that deal out because they think rates will come back down. So that wards off a lot of volume in those cases and helps banks kind of manage this capacity. And so this big, and again, let's be clear, this is a refinance boom. I mean, yes, we've seen a lot of purchase volume, but when rates drop like that and we see this floodgate open up of applications, it's predominantly refinances. And just to give you guys an idea of some statistics, I mean, year over year, from this time last year to now, lock volume, so lenders going in and pushing a rate lock, that volume's up 117%. Actual fundings year over year are up 53%. And again, these are nationwide statistics. These aren't specific to Maricopa County. But they're important because they tell us the story, right? The other part of that statistic, which you might find interesting, is compared to 2019, if you look at year to date, right now, purchase lock volume, so purchase business, is up 11%, okay? But refinance volume is up 216%. That's a massive, massive difference, right? So it goes to show you that the lion's share of this volume was refinance business and still is. But the purchase money is actually higher than it was last year at this time. Now, I also realize statistics are never real time, right? This could have come out a week or so ago based on data from a few weeks ago, but it at least gives us an idea of what's happening. And so banks, the point I'm trying to make is banks are stressed. They're absolutely stressed with trying to get through volumes and trying to manage this whole loan process with what's going on. I'm going to touch on forbearance just quickly. You guys are hearing a lot about forbearance. It's a really hot topic right now. It's kind of the doom and gloom topic, in my opinion. It's the thing that if you let your mind go too far on this particular one, you can see where people start asking about, hey, Stuart, is this going to be another housing crisis like 2008? And I've said this before, but I know there's, we have new people on today's call. Remember, this is not a broken financial system. So it's very different from 2008. That was it's apples and oranges, so you cannot compare them. Most companies going into the COVID situation were hand over fist in much better, healthier positions than they ever were going into the 2008 housing crisis. So it's just different. And I think most people now realize that. But on the forbearance topic, the scary thing about this is you've got the federal government that's essentially saying, yes, we need lenders to allow forbearance, and they need to start coming up with plans for this. So then what happens is that trickles down to the lenders. So Chase Bank, Wells Fargo, Bank of America, all the big servicers out there, and they're all going to make their own guidelines based on what they're going to allow for forbearance and what those parameters are going to be. The reason it's scary is because it's being based, so they say right now, off the honor system. So they're not requiring you to call and prove or document in any way that you're going through some sort of financial hardship due to COVID or something else, or that you don't have the ability to repay that mortgage. So You know, a couple weeks ago, the recent statistic at that time I'd heard is of the applications coming in for forbearance, 80% of them were what they call vanilla grade A borrowers, okay, which is good credit score, good money in the bank, good job, low debt to income ratio. So all of just the standard things that we look at. So that shows you that if the general population of people that maybe don't need a forbearance are trying to get one, and in all honesty, I mean, can you blame them? I mean, if someone gives you a free lunch, do you take it? You know, I don't know, but I think most people do. So the reason that gets scary is because then you start having this speculation of what are these forbearance numbers really going to look like when people who really do need them start actually applying too. Excuse me. And what a lot of people didn't realize a week or so ago, and I feel like now it's starting to get out there a little bit more, is what is actual forbearance. It's not loan forgiveness. It's not your lender saying you don't have to make mortgage payments for 3 months and then just don't worry about those payments. We're cool. Okay, that would be nice. They're going to give you options, and some of them are going to let you tack on those 3 missed payments, you know, on the loan and pay them back over time. Others are going to require the consumer to pay those back in one swoop. So where that to me is scary is if you've got someone who's in desperate need now, losing their job, doesn't have the hours they used to have, and really needs that forbearance, and their servicer, because remember, you don't get to pick your servicer. Whoever's got your loan's got your loan. So if I have to call Chase Bank to find out what my options are, and Chase just, and I'm making these up, guys. I don't know Chase's policy. And Chase says to me, we have one, you know, guideline here. You can miss 6 payments, and then after 6 payments, you're going to make all 6 payments at once. Well, if I'm in a distressed situation and I've got a family, I'm probably going to make a short-sighted decision potentially and just say, okay, forbear me. I need relief right now. I don't want to make payments for 2-3 months. And then 6 months from now, if my situation hasn't gotten better or I haven't been able to save money, 6 mortgage payments all at once is a pretty scary prospect, I think, for anybody. So that's where it starts to get a little bit scary as far as this snowball is going to roll downhill and what's that going to look like later. And, you know, 70% of all outstanding mortgages are federally backed. And the reason that's important to note is that most of those loans all of those are going to be eligible for forbearance. So we're possibly going to see this massive wave of people coming in, which I think Liz might have some stats on this in the slides, but everything I'm reading, I mean, the forbearance applications, the amount they're going up daily it's phenomenal as far as to see how quickly they're going up. And as of last week, one of the biggest servicers in the country, I was reading an article on them, and they were intaking at the time anywhere from 8,000 to 22,000 applications a day for people wanting to forbear. So, and that was a week and a half ago. It's way higher now because now it's getting out there. People are putting their rules in place. So it's an important part of the unknown of where this whole thing is going to go. The other thing to mention, just lastly on the forbearance topic, is this is really important. So if you guys can, you know, make sure you're listening to this piece. If you have a client that's asking you about forbearance, or a friend or whoever, know that most lenders are coming out with rules right now saying that if you're in forbearance on a mortgage, we're not giving you another mortgage. And I mean, from a common sense standpoint, it makes sense, right? And I'm going to give you a real life example of what I'm talking about. So last week, one of the loan officers at our company had a client who's got a rental property and is in the middle of purchasing a new property. So they're under contract, close of escrows in a week, and he has another rental property somewhere else he's had for years. And his tenant called him and said, hey, I'm just curious, you know, are you doing this forbearance thing? Because it'd be kind of nice if I didn't have to pay you rent for a couple months because of my situation. And so this gentleman, you know, trying to do what he felt was good for everybody, he went and called his loan servicer who holds the loan on his rental. And then the servicer, you know, he asked some questions and he did not apply. He didn't do anything official. He just asked questions to understand. And then he hung up the phone. And then a few days later, we went to do our credit refresh because we were getting ready to close the loan. And if you guys aren't aware what a credit refresh is, every lender does this. Within a certain amount of days of closing, we're required to check the buyer or the borrower's credit again. And it's not a hard pull. We don't look at credit scores. think of it as we pull the curtain back and we look to see if they went and bought a new car. Did they have a new inquiry? It did a late payment all of a sudden report. And in this credit refresh process, this particular client, all of a sudden it showed that his mortgage was in forbearance. And because of the type of loan we were doing, we can't close the loan. We cannot close his new loan on his purchase. So the loan officer called the client, and the client, of course, freaked out when I didn't even apply for forbearance. He called his loan servicer back, and his loan servicer ended up admitting that they made a mistake and they didn't mean to report it to the credit bureaus. Fortunately, the whole thing got fixed. We got the documentation and we were able to, get the deal done. But I tell you that story to know that, like, those are the kind of weird things that are going to start happening. And know that if someone starts talking to you about forbearance and it's a client of yours that you're showing homes to, be aware, make sure they know that, hey, if you take this forbearance route, there's a possibility that when you go to get your new mortgage, if that shows up on your credit, your lender may not fund that new loan, right? And we can argue all day whether it's fair or not, but if you look at it from a bank's perspective, if you're going to say, hey, I'm raising my hand, I can't really make my payment over here, well, why would we give you a loan over here to pay on? It just doesn't make any sense. So really, and that's relatively new data that we're getting in the last week. So I think that's important for you guys to remember. Okay, I think that's it on that slide, Liz. And I don't know, does anybody have any questions on what I just went over?
Hi, this is Adina. I do have a question. So you're saying that if somebody's been in forbearance and say in 6 months, they can't come up with the 6 payments all at once and they want to refinance, and they're going to have some issues trying to do that as well.
Yeah, I'm just saying that some of those servicers, that's going to be the way they do it. They're going to say you can miss X amount of payments, but you will pay them all. You owe us all of them as soon as that window is over, right? So let's say it's 3 months. After you miss 3 months of payments, you're going to make all 3 payments at once. And then if they can't, I think that's, and I'm glad you asked because I didn't finish kind of one of my points, which is that's the doom and gloom, right? If all these people do this and can't make those payments, what happens next? Defaults. What do defaults mean? Foreclosures, right? And then you get into the whole, the housing crisis is going to happen again, which I personally am not predicting that at all, just to be clear. I'm just saying that's where, some people try to go with it. But to answer your question on a refinance, yeah, that could potentially, as soon as they go into forbearance now on a loan and then they go apply for a refinance, most lenders probably aren't going to do that refinance for the same reason. So think of it as simple as if you put a loan into forbearance, you are running the risk of not being able to get any new loans, period, on mortgages. Is that clear? Clarify it?
Yes, thank you.
Okay. Okay. So the next slide here, headlines, and these are changing daily, of course. And, for what it's worth, I feel like the last 3 business days have been not as crazy. I feel like I'm sensing a little bit of a relief on industry changes being announced. We kind of had a pretty rough 2 weeks. And that could change tomorrow, but these 3 up here are just some good ones to hit. So Calabria, Mark Calabria is the FHFA director, which is the Federal Housing Finance Association or agency. It's the federal arm that sort of is at the top that tries to delegate rules, regulation on through Fannie Mae and Freddie Mac, who are conventional loans, and Ginnie Mae, who is FHA loans, and FHA on trickle down to the banks and the consumers. And, this article that we snipped was just him saying it may be harder to get a mortgage after the whole COVID situation ends. And then after this, lenders get stricter as some borrowers think they don't have to pay, right, because of forbearance. And so I'm just going to touch on those 2 real quick. So the fact of the matter is, if you were to ask me, is it harder to get a mortgage today? I would say to you, that's a very tough question to answer because it depends on the type of person trying to get the mortgage. Overall, if you're just looking at generalizations, is it harder to access mortgage credit than it used to be? The answer is yes, right? Because products have gone away, changes have happened, they're all restrictive and conservative. So all of those things mean that mortgage credit isn't as available as it was. And I'll kind of go over here shortly what those big program changes are and who really is getting affected by this, so you guys understand that. But it absolutely is true that mortgages are going to be a little bit harder to get. But again, it's only going to be for, and I don't mean to say only, but certain demographics of consumers based on their situation are going to have trouble getting a loan. Many other consumers are not going to. One of the biggest changes that has been announced recently, and this happened late Friday afternoon, is that Chase Bank came out and said that they are requiring 20% down and a 700 FICO score on all transactions. Okay, so that's a sweeping nationwide change. So if you walk into a bank at Chase and you want to go buy a house and get a mortgage, they're going to make you put 20% down. If you come through VIP Mortgage or any other mortgage company you have affiliation with, and we are used to sending loans to Chase Mortgage, guess what? We're all stuck with that rule too. So here's the good news, bad news with that. The bad news is Chase, who's a big bank and a big player and arguably one of the most powerful banks in the world, is making a huge conservative change that I hope other banks don't follow suit on. Because if too many other banks follow this rule, then we are going to see a massive amount of buyers get cut from being able to buy a house, right? I mean, I can tell you from all the transactions that we do as a company, and you guys know this, I mean, a lot of people put 20% down, but a lot of people don't, and a lot of people can't. And that doesn't mean they shouldn't be able to buy a house. So I'm hoping this a herd mentality doesn't come into place with this Chase announcement, and a lot of other big guys follow suit, because I do think that will be an unfortunate situation for us for a temporary period of time. The good news for now, and to back up, the other reason that was bad news and kind of shocking to us in the industry is because conventional loans. We've already kind of been through the gamut of the jumbo loan changes, which I'm going to get you guys specific what those are here shortly. But when this announcement came that was on agency loans, which means conventional Fannie Mae, Freddie Mac, that's a big deal. So the good news is, and you're probably thinking like, what in the heck could the good news possibly be? The good news is that as of right now, it is only Chase. So mortgage companies like us, the beauty of our setup is I've got 30 plus servicers that I can sell loans to. So if Chase is on my list and all of a sudden they're gone, okay, I got 29 more guys I can still do a 3% down conventional with. So no one else has made these changes. We're still business as usual on low down payment, conventional loans. But important to know about that topic. Okay, so into the product changes. So here are the main changes that have occurred that are going to affect people. Number one are going to be FHA loans, FHA and VA loans, which we call government loans, okay? And the main change is most lenders are not going to do these now under a 640 FICO score. So you used to be able to do these to a 580. And in all fairness, I think there's still a couple mortgage companies out there that haven't made changes here, and they're just going to see what happens. But the vast majority of lenders are now not doing low FICO score FHA and VA loans. So 640 is kind of that cutoff. Now, the good news on government loans, the pricing is unbelievable in terms of interest rates. At VIP, we are, going directly to Ginnie Mae for these products right now. What that means is I'm not going through Wells Fargo like we would normally. I'm not going through Chase Bank. I'm going directly to the aggregator for these products. And what that does is, in a market like this, it gives us better pricing, is basically the simplest way to put it. So the rates on those deals right now are very good. To give you an idea, I think I saw a quote yesterday on a 30-year fixed FHA. It was like 2.75. I mean, it was, I couldn't even believe it without having to pay a bunch of points or anything. So there is some good in those loans. The pricing is really good. DPAs, a lot of confusion on the DPAs, a lot from everybody, including my own company and me. I mean, the changes, so many coming across the desk. It was like trying to figure out but the Rubik's Cube. Here's where we've landed. The DPA, down payment assistance aggregator, has not said we are not doing these loans. That's where a lot of the confusion is. So you have lenders saying we're not doing these loans. And then naturally that's the game of telephone. And then as an agent, if your lender tells you that, you just assume fairly that those programs are gone. They're not gone. It's just a lot of lenders have decided to not do them or have restricted their guidelines on them. So to give you an example, in our world, at my organization, DPA loans, we will not do them under a 660 FICO score, okay? On a government, which is FHA, and on a conventional, we won't go under 700 FICO score. And the aggregator, quite frankly, who puts the guidelines out for this product that every mortgage company gets it from, that's actually their guides. So we're just following their rules. It's not our own special rules, but we are still doing them. So I think that's all really I need to touch on the DPAs. Non-QM are non-qualified mortgages, which are basically your niche portfolio products, which would be things like, as you know, you have to have 7 years from a foreclosure to get a new conventional loan. A niche product would be you only have to be a day out of foreclosure or a year out of foreclosure. Or another niche example would be a bank statement program. So you've got a self-employed client that writes off all their income. They don't qualify on paper, but we can get rid of their tax returns, get a bunch of bank statements, add up their deposits, and give them a hypothetical income figure to qualify with. That's a bank statement program. Those programs essentially are gone. The big lenders and servicers that bought those and did those loans pulled out of the market completely. So those are, bye for now on those. Jumbo, we've seen some big changes. And just as a reminder, jumbo loan limits above $510,400. Okay, so basically a $511,000 loan, not purchase price, or higher is a jumbo loan. Jumbo loans, the big changes have been the low down payment products. So the 10% down jumbo product, which has been a really, really popular product for years. Most banks and servicers, Chase being one of them, Wells Fargo being one of them, have completely pulled out of those products. Wells Fargo made an announcement, it's probably been a week and a half now, where they have stopped doing jumbo loans completely on the wholesale side, which means, with companies like VIP Mortgage. I believe if you walk into a Wells Fargo, which is what we call retail, they probably are still doing jumbo loans. I know they're highly restricted. They released another memo a week ago that this is just kind of interesting. If you have a jumbo loan and you're a Wells Fargo client, so you have a bank account there and your mortgage is with them, they will only refinance you. This is jumbo only. They will only refinance you if you have $250,000 in the bank with them. So you can see where they're raising this bar to just try to mitigate doing these loans at all, and then just get them to what they feel are, grade A borrowers that they're not going to have any problems with down the road as far as not making payments, et cetera. We are successfully putting together solutions for the 10% down jumbo borrower, like with a first and second mortgage. So we've saved a couple deals that way doing that. So they can still be done. It just can't be done in your more common traditional way of doing one jumbo loan. You can no longer do investment properties on jumbo loans. They're not that popular anyway, but that's another thing that's changed. You can no longer take cash out on a refinance on a jumbo loan. That's gone. So those are the main jumbo differences. Just like the conventional Chase rule, jumbo is basically kind of gone to this straightforward 20% down or more primary residence, second home stuff. They have increased their reserve requirements depending on the structure, meaning with jumbo loans, there's always a reserve requirement, which means if your new mortgage payment we propose is going to be $3,000 a month, you may have a 12-month reserve requirement, which means I have to have $3,000 times 12, right? $36,000 in the bank above and beyond my down payment and closing costs. And the reason banks do that is that's kind of their insurance policy, that if you lose your job tomorrow, they know you have 6 months of payments, or 12 months in our example. Those reserve requirements are going up right now with jumbo servicers. So the getting credit there has definitely changed. Any questions on that?
Stuart, one thing I think just real quick to touch on, and you kind of did, but talking about kind of the why behind these, why lenders are restricting these type of programs is really just because these are traditionally the higher risk type of loans. So maybe just if you could touch on that real quick so people can understand.
Yeah, absolutely. So there's a lot of reasons for the why, but one of the biggest ones is, like Liz said, the higher loans are pieces of paper, okay, that get sold. There's a little piece of paper I get to hold on to right here, and I'm going to go out to the open market and I'm going to sell it to somebody, and that's a transaction that happens. So Chase Bank takes their piece of paper and they sell it off to somebody. And one of the reasons these products are gone is because when Chase Bank now turns around to go sell this loan on the market, they're looking into an empty room with no buyers. So think of it as, if I make cars for a living and I have a car factory, if all of a sudden there is literally nobody lined up to buy a car, I'm not going to keep making cars. So that's my simple analogy onto what's happening there. There's no liquidity in the secondary markets for these products right now, which is a fancy way of saying there's no buyers. There's nobody that wants to put their money into them. They don't want to buy what we call mortgage-backed securities. So because investors are scared of that, right? Because when you sell a loan to an investor, the investors wants the servicing on that loan, meaning they want to collect those payments over time, okay? Well, guess what? If all of a sudden we're talking about forbearance and people aren't going to have to make payments, and I'm in the business of buying pieces of paper where people pay me payments, but now those payments aren't going to be there, I probably don't want that investment right now, right? So hence, liquidity's gone. I'm now going to take my money and go invest it somewhere else. I'm not going to buy these mortgage-backed securities. So there's a few reasons, guys, for the why behind these products going away, but the big two are, that's number one, and not in any particular order. And number two is just the pure risk of it. Just basically, nobody wants to be left holding loans they can't sell. And that's where they get scared. And that's really where the DPA stuff comes in, the low FICO score FHAs. Those kind of loans are predominantly at a much higher statistical rate of default on payments and derogatories just by nature, right? They're just because they're lower FICO loans. They're people that you're barely qualifying on debt to income ratio. So as we call this, if the wind blows, all of a sudden they don't qualify. So that triggers early payment defaults, not making payments on time, which is totally different than forbearance. That's just literally like not even making the payment and not doing forbearance. And when a lender like VIP Mortgage closes that loan, and then I sell it to Chase, if 4 months from now, Chase calls me and says, hey, this loan you sold us from Bob Smith, Bob hasn't made a payment in 4 months. You're buying this loan back from us, and we have to buy the loan back from them. So lenders know that, and everybody's trying to protect the house right now. Nobody wants to get in a situation where they have to write checks to buy loans back, because that will put mortgage companies out of business. Your cash reserves go away. If all of a sudden you got to buy 20 loans back, depending on the size of the company, this is how mortgage companies can go under pretty quick.
May I ask a question?
Yeah.
This is Sue Billings. So I have a client that went under contract. I represent the seller, and the buyer has a Chase mortgage. It went under contract on the 8th of April, so 5 days ago. He does not have 20% down. I'm, of course, unaware of his credit score. I've reached out to the buyer's agent to confirm that the new restrictions that Chase is employing does not harm this deal. And she has said it doesn't, but I'm not sure if I believe her. So, I mean, all I can do is ask, but do you have any insight as to when it became effective?
I do. So it's a great point. I'm looking at the memo right now. When these come out, Sue, they always give a date. So on this particular memo, it's any pricing commitments taken on or after April 14th. So basically what that means in my world is, if the rate is not locked with Chase by today, they're not going to take it. So if in your situation, that client's already locked the rate with Chase, yesterday or a week ago, it's essentially grandfathered in. They're not going to cut those out.
Great question.
Thanks.
Does that answer the question?
Yeah, I'll have to confirm that they locked the rate, because the PQF I have, I've never gotten an updated one since we went under contract, and I need to confirm that she's locked or that he has locked the rate.
Yeah, that would be a great proactive thing to do today, because it does state it's got to be today. Anything after today is not happening. Okay, verifications. I'm just gonna hit this quick, guys. So now we're kind of getting into, we've talked about a lot of the why, what's going on out there, what are the product changes, and then now, how does this all relay into the assembly line of manufacturing a loan, kind of the button pushing and the lever pulling I was talking about. Because as you guys can probably imagine, there are more steps in manufacturing a mortgage loan than you ever see. It's an unbelievably intensive process, and there is a reason why banks like Chase, because you might be asking yourself, why is there retail and wholesale? Why does Chase have a rule on retail, but then on wholesale, if they go with Stuart at VIP, it's different? Why do they even do that? The reason is because really Chase doesn't want to originate mortgages like we do. They don't want to do the manufacturing of the loan. It's extremely expensive. And they would rather just buy the loan from someone like me who puts it together for them. I'll put the whole puzzle together and then put a bow on it and sell it to you. That's what they want. The only reason they originate loans on the retail side is because they have to, right? You can't be a full service bank and a guy walks in and asks about a mortgage and you go, oh, sorry, we actually don't do mortgages. So it's a loss leader for them. So there's a lot of steps involved, okay? And the verifications are one of the things that we're seeing some changes on as far as the rules. So one thing, more good news, is Fannie Mae, Freddie Mac, they've really all done a great job, in my opinion, of acting nimbly in this market and coming down with changes that they know will help us get loans done when we are having issues with certain things. One of those is verification. So verification of employment. This is what the form looks like in the beginning of a transaction that we send to your client's, a company. Send that to Honeywell, the HR department fills it out. Days before closing, we're also required, and again, this is all lenders, this is not specific to my company, we're required to make a phone call. It's called a verbal verification of employment to Honeywell in our example, and we just simply say, does Liz still work there? Yes, she does. Thank you. Click. We make a little note. We put it in the file. Good to go. Well, what's happening is these verbal verifications now are harder to get done because the HR departments are short-staffed, they're working from home, and they're not answering the phone. So Fannie Mae's come down and Freddie, and they've said, okay, we can take an email. We can, if you can't get that, we can take a more recent paycheck stub, a more recent bank statement printout showing their payroll getting deposited. So they've come up with some alternative ideas to help us get these things done. Tax transcripts, and actually there's something else important here you need to be aware of. Fortunately or unfortunately, and whether it's right or wrong, lenders are now being required to scrutinize files much more based on what somebody does for a living. Because if I've pre-qualified and gotten somebody under contract who is a server at Flower Child, okay? I don't even know if Flower Child has servers, that's a bad example. You guys know what I mean, at a restaurant. And I got them through underwriting, they're approved, everything's good. And then all of a sudden I go to do this verbal verification and they come back and say, well, we've got all of our servers on furlough right now, not getting paid because the restaurant's not open. Lenders aren't going to close those deals. They are not going to close a loan where somebody does not have a job technically and is not getting paid. We have examples of this. So the reason I tell you that is it'll be helpful in your own world as you're dealing with your buyers. You guys are all always very good at understanding somebody's whole picture, what they do for a living, what makes them tick. And I would have your ears perked up a little bit more for what they do for a living and maybe even ask some questions like, hey, what's going on at work? Like, can you work from home? What's that about? Because the lenders are going to ask these questions, and the lenders that aren't asking these questions are setting you up for failure because those questions are going to get answered without even the lender asking towards the end of the transaction by doing these steps. And then you're going to have, what I call the landmines, right? Someone's all of a sudden going to walk on a landmine 2 days before closing. You're going to get a phone call that says, I can't close this loan. Here's why. So right now when we're pre-qualifying people, we're being thorough and proactive and having these good conversations. And the good news, guys, is we're not scaring people off. Everybody at this point, unless you truly have been living in a cave, knows what's going on. So these are welcomed conversations. They're not, there's no friction. They understand why we're asking the questions, and they appreciate it because we're telling them, hey, Liz, I'm trying to protect you and your pre-qual and out looking at houses. Just want to make sure that if there's going to be any changes to your employment the next month or so that you foresee, let's just talk through them now so I can help you put solutions in place, right? So that's really important. We are going to start seeing some deals not happen because of people not technically having jobs or getting paid, and that's a problem for closing a loan. Tax transcripts really quick. If you don't know what tax transcripts are, most people don't, or they think they do. And that's nobody's fault. Lenders are terrible at explaining this. When you give me your tax return, I have to assume on the honor system, that's the tax return you filed with the IRS. The only way I can verify that is by getting what's called a transcript. So a lender goes out to a third-party database system, and we pull in your tax transcripts, and it's like a summary of all the numbers on your tax return. Then an underwriter takes that and compares it to your tax return and validates that what we have is what you filed. Where that's become a problem is the IRS has come out and said, we're no longer issuing transcripts. I mean, they don't have the bandwidth based on all the stuff going on. So lenders, that's a really tough one for lenders. VIP mortgages stance, we made an executive business decision that we are funding loans without tax transcripts. We just, it's an unfortunate situation for everybody to be in, but we're not going to hold up fundings for that. We're going to do our best to be thorough and validate that what we have is what is accurate, and we're going to put some trust in the American public and hope that people know we're taking care of them and they're not going to lead us down a wrong path, and we're going to get deals done. So that's really it on the verification piece for now. Appraisals, I'm just going to do really quick, guys. It's not a big deal. If you've heard me talk before, I keep saying it's low on my totem pole. It's even lower now. We're not hearing about appraisers saying that other lenders are giving them orders for exterior only appraisals and not wanting people to go in their house. It's just not, there's not enough of that to where any big changes are being made. The good news is that Fannie Mae and Freddie Mac have come down and they've allowed us to do what are called drive-by appraisals if you have somebody who's not comfortable with an appraiser coming into their house. I only know a few examples of this, of all the people that we communicate with, so it's a very low percentage. So not really a big deal. I would tell you guys, business as usual with appraisals. I'm even starting to see them come in a little bit faster now. They had slowed down for a bit there because of those high volumes we talked about. But I feel like I see things clipping through a little bit quicker now. So all's good on that front. And okay, so this sort of goes into, and we're almost done here, guys. This goes into a lot of what we were talking about earlier. And, where is lending headed? Like, what does this all mean? What's going to happen next? Stuart, what are interest rates going to do? I get asked that question a lot. And this is a pretty telling graph about mortgage credit availability. And I know we've already talked about this, but I think it's cool for you guys to see. Look at the sharp, I mean, that's like almost a 90-degree angle coming down. And it says that drop in purchase loans largely took place in the jumbo. Well, let me hit that in a second. Sorry. So all this graph is showing you is the amount of availability to mortgage credit. So anytime you see a dip like that, you just know I know just by looking at this graph that that's a product change. Products have left the market, which means the availability of credit has been severely reduced, which is true. But if you look at this graph, it goes back to 2011. There is nothing even remotely like a drop like that, right? There's a little bit of one in 2018, but this is a pretty massive sell-off in products and availability. So at first glance, you look at this and go, oh my gosh, this is bad. Is anybody going to be able to get a mortgage in the future? But I think what we have to remember is what I talked about earlier is the percentage of people affected by this right now, okay? And of course, I have to bold and underline and highlight right now because we could be having a totally different conversation tomorrow, I don't know, are going to be what are considered to banks as high-risk profiles, which are low credit scores, low money down. That's simple, okay? No money in the bank. Those are high risk to banks because those three topics lead to early payment defaults and people not paying their mortgages, statistically speaking, okay? So I know it's not fair to put everybody in that category, but meaning that just because you're barely qualifying, you're not going to make your payment. That's not what I mean. But banks look at this stuff based on, risk analysis. So that's where we are losing some consumers right now are in those realms. And then we put in here, because it's just interesting, the drop in purchase loans largely took place in the jumbo loan space. And the Mortgage Bankers Association published a mortgage credit availability index, which last week showed a total decline of 16.1%. But if you look at the breakdown of jumbo versus non-jumbo, the decline was 36% versus 2%, right? So it just goes to show us that in the conventional conforming loan space, it's pretty much business as usual. Other than that chase change, but you can still do a 3% down up to a $510,000 loan size with a 640 FICO score. Not have reserves in the bank really. I mean, so all those things still exist. So it's just really that low down payment jumbo and that, super low FICO score spot. And, as far as my predictions is what's going to happen, how this is all going to play out, because people are scared. People are scared in the industry. We're a purchase-driven organization, right? We're not a refinance shop, so to speak. So even though we're doing tons of refinances right now, and just to put in perspective for you guys, since we started VIP Mortgage, last month was our biggest month by a pretty significant margin in volume ever. And April's going to beat last month. Now, it's a ton of refinance volume, but it's just another, I only share that for you to understand that, wow, like that's how much business just came in the door. One of the big mortgage companies, nationwide company, I read a statistic on that said that, they locked rates, like 1.4 billion more in rate locks in the month of March than they've ever locked in a month ever. And their total locks was like, like 6 billion or something. 5 of that 6 billion got locked in the first few days of March. That shows you how fast those floodgates opened up. It was just crazy. So to me, the thing that we have to understand is the way it sits right now, these are all temporary changes. These are mortgage companies and banks going, okay, I don't want to get caught in a bad position later. I learned hard the last time. I'm going to keep my cash reserves high, which means I'm not going to put myself at risk to buy loans back, which means I'm not going to close loans that are risky because I just don't want to deal with that right now. And so everyone's just sort of pulling back to be safe and protected, which is a good thing in my opinion. It's also going to have a healthy cleansing of our market on the mortgage side, as well as probably a version of it on the real estate side too. Let's be honest. There's a lot of people buying houses that really shouldn't be buying houses. And I think a lot of those people are going to see that coming into this and are going to put more preparatory things in place for their plan for when they're really ready to buy a house. And so to me, those are all positives. And I do feel like this is a window. This window will close and these programs will come back. Believe me, guys, there's plenty of money on the sidelines on Wall Street right now, plenty. And the stock market's already come back. I think at its worst, it was down 30% from its highs. I think it's only down, at least as of yesterday, and the business was down like 18% from its highs. So it's already come back a huge amount in a short period of time. And it shows us that there's still plenty of money flowing out there. Investors just aren't sure where to put their money. And the reason I'm telling you this is because as soon as this payment thing goes away and things are normal, investors are going to want to buy mortgage-backed securities again. And as soon as they do that, that puts the liquidity in the system. That lets these big guys go, whew, okay, I can sell my loans now. Now I'm going to open it up, bring my products back. So this is not doom and gloom, and that's not how I'm looking at it. And I think what I'd like to end on, which is another huge positive, is interest rates, okay? If you remember what I said in the beginning of this call, in early March, they dipped to, like a 3.1 range, give or take, on a conventional, just vanilla loan, okay? And then they shot up to almost 4%, I told you. And then they kind of leveled a little. And now we're starting to see some relief on the rate sheets. And now the 30-year fixed in some cases is right around 3.2, 3.3. With some version of a discount buy down, you can be close to 3. So we're still off that super, super low, but it's not very far off. And this is a window of opportunity as far as I'm concerned. Interest rates were heading the other way until all this happened. And the Federal Reserve, who did an emergency rate cut, gosh, when was that, a month ago now? Probably more. They've already come out with some comments and have alluded to that as soon as this thing's over, like, you know, I think the comment was, we're going to keep rates low until this thing is over, which is, in my opinion, watching the Fed over all these years is sort of their way of playing the seed of saying, hey, don't get used to this. Like, as soon as we get out of this, we're going to start changing things again. So it's like COVID brought us low rates. COVID sucks, but low rates don't. So if I'm talking to a potential buyer, someone who's serious, I mean, that is something legitimately to take advantage of. And people that we're talking to about refinances and things, they're like, well, I might wait to see if rates go lower. Yes, there's people out there that think rates are going to go lower, but I always turn the question around and say, do you think a 30-year fixed mortgage is going to go to 2%? I don't think it's going to. I can't predict tomorrow, but if it does, great. Refinance again a year from now. So who knows what happens there, but just the air has been cleared with all the weirdness on the price sheets, and now rates are where they should be, and they're low, and they're fantastic. The one other thing I will add to that is with so much information and so much conflicting information, it's hard for markets and banks to make decisions. And even though we say all these things about this is temporary and it should come back to normal soon, and the last 2 days alone, I mean, the headlines coming out from Governor Cuomo in New York's, you know, he's doing these daily press conferences. Everything is starting to allude to this flattening of the COVID curve. No one knows if it's actually going to flatten. It could just spike back up tomorrow. But now all of a sudden you're hearing the talks about, right, these governors getting together and putting together reopening of the economy packages and things like this and plans. So it starts giving people this sense of confidence, and the stock market does well today, right? Then on the heels of that, Morgan Stanley comes out and they had this big prediction that said, this is far from over. There's going to be another huge spike in COVID cases in December. And based on all of our analytics and our, you know, biotech people we're talking to, and we are not even going to see a version of normal markets until second, third quarter of 2021. Basically write 2020 off. It's not going to be normal anytime soon. And there could be some truth to that too. So, you know, the point is, who knows, right? Everybody's just guessing, and all we can do in our industry is be the professionals and be as educated as we can and try to help our clients kind of maneuver through this and not promise them things that we don't know are 100% fact. And anyway, so I just thought I'd share that with you guys if it's helpful.
That is awesome, Stuart. I think that's a great way to kind of wrap it up. We'll open it up for questions here in just a minute, but we do have some other great resources that we can offer you guys. I'll send an email out to all of you with the links for these attached, but we know that a lot of you guys are getting questions from your clients about mortgage relief options, the whole forbearance topic, and rather than advising them, because that's really not your job, we have some great resources that you can provide to them and allow them to do their own research on whether that would be a great option for them. There's some great articles that the CFPB has put out. We'll direct you to those. We also have a great synopsis of what the CARES Act was, what the different stipulations that were passed in there, and then some great options for business owners as well. We put the Crawford report on here because we really believe that that is the best resource for you guys as real estate agents to get local market statistics about real estate. We are sponsoring a class tomorrow with Tina Tambor. I believe it's at 2 p.m. I can send you guys the link to that, but she's basically going to be talking about really how this has affected our local market. I heard it about a week and a half ago. It really opened my eyes to, you know, it's not all doom and gloom in our housing market here. Things are still selling. We still have a very strong demand locally for housing. So that has really made it so prices have not dropped much on the sales side. So that class is tomorrow. We encourage you all to tune into that. I'll send those links out to you guys after. And then some other tips that we really believe as professionals in our industry, we really believe that we need to stay focused on the positive. And with all the misinformation out there, it's really important to be compassionate and considerate when you're talking about the crisis with your clients. Proactively communicate with them by providing information and value through emails, text, social media, or videos that you're doing. Be focused on the positive and be solution oriented, helping them find ways to purchase homes. As Stuart talked about, there still are options, and share kind of what you're doing during this time. So those are all things we think will really help you be a professional and grow your business during this time. And then we'll kind of open it up for questions. I see one already from Kelly. That is Tina's tomorrow class the same as last week, or is it updated? It is a brand new live class. Tina will be on with us, so it's updated. Because of what's going on, they're updating all of their charts and graphs daily right now to see what the effects are as far as cancellations and things like that. So it is all new information. And if anybody else has any questions, feel free to type them into the chat or unmute yourself so that we can make sure to address them. Stuart's happy to answer any questions on the lending side that anybody has. And then I'm going to put my email address in the chat as well. If anybody has questions on any of the information that we presented today, we would be happy to send you the links to those articles that kind of touch on what we talked about. Otherwise, I think we're done. So yeah, anybody feel free to chime in with questions. And if not, thank you so much for joining us. We really hope that it was helpful for you, and we'd love to be a resource for you and your clients if you ever need us.
Thank you.
All right, I don't see any questions.
Thank you.
Thank you. Appreciate you joining us.